So I think what happened this week is actually pretty important because I think the markets were really trying to force Jerome Powell to start the cutting cycle. And now they had to move the date at which they could expect cuts out by a year. And I think that we're only starting to see the reverberations of that. You're going to have to reprice a lot of risk assets. So if you put it all together, oil is creeping back up. So commodity prices essentially are trending up. I don't think that's going to have a big impact on inflation because of the way that owner equivalent rents and core CPI is calculated, because it's calculated on this 6-month lag, this dumb nonsense of just how arcane our system works. But that's going to spike down. So basically the Fed's like saying, we know all of this is happening. We're sitting on our hands. But the problem is that if you add another 100 basis points to your discount rate for an unprofitable SaaS company, my gosh, guys, you're taking like another turn and a half of market cap out of the business. Like if you thought it was worth 8 times, it's now worth 6.5, 6 times. So unfortunately, that's going to hurt everything that's not the top 7 tech companies. And everything else is just going to kind of meander along for a much longer time. So it's really good for the Magnificent 7. I think it's really bad for everything else. And we're going to be in a holding pattern for a while.
Crude oil is at, let's see, $89 a barrel. Yeah, it's getting back up there.
Remember this conversation? I told my CEOs, guys, let's get enough cash to last through the middle of 25.
Sure.
Remember, I was pretty clear about that to folks. I mean, get to default alive, but if you can't, please have enough money to the mid of 25. I think that was wrong. I think now you got to be Q1 of 26 and maybe even mid 26. So now I have to go back to all these CEOs and redo an entire justification for why they need to cut even more people, cut even more expense, cut more burn. I don't know where we're going to find another year of burn in most of these businesses. So I was wrong by at least a year, Jason, because of this. I think I got the words right, but I got the timing wrong.
Yeah. Well, just to further translate this. Okay, so the markets right now are definitely taking a bath. The growth stocks are off significantly.
Expect them to be off more.
Yeah, and the reason is because the market had started to price in rate cuts next year. And now the Fed is saying that because inflation ticked up a little bit, it's not coming down as much, we have higher energy prices, we may not get those rate cuts. I think the Fed still maintains that we'll get 50 basis points of rate cuts next year, but the market was pricing in more. And I think people are starting to wonder if we'll even get the 50. So as a result of that, interest rates are going to stay higher longer, which means that risk capital will be less available. So valuations are going to go down, or at least they're not going to be racing back up like they used to.
When I was saying mid 25, Sachs, that was because the forward curve started showing cuts in early 23. You know what I mean? So I was like, okay, let's assume they're wrong by 18 months. It turns out that initial data point in early 22, my God, we were wrong by 3 years. So
right.
Not a year and a half. Right. It's brutal.
And I think the X factor here is that we're running almost $2 trillion deficits in peacetime. Well, I mean, we're not in a direct war, we're in a proxy war, but in relative peacetime and in a relatively decent economy. So what happens if either of those things change? And what happens to long-term rates as all of these debt issuances have to get raised, as the Fed has to keep selling more treasuries to fund our deficit and debt at these higher rates? Do long-term rates keep going up based on the debt financing needs of the federal government?
And this is again where, we made a huge mistake by politicizing this idea of raising money beyond 30 years. We made that mistake under the Trump presidency because people reacted to Trump saying it. But it was the smartest thing we could have done to give our kids and our grandkids a reasonable economy. And Freeberg has been right all along about just like our spending is just going up and up and up. And now short-term rates are really high. Maybe we'll have enough political will to just get out of the Fed's way, and the Fed can actually look at raising in durations past 30 years. Because if you believe that we're going to start an aggressive cutting cycle at some point, and you believe we'll get back to like a 2% terminal rate, you could theoretically justify 50, 60-year bonds at much lower than the 30-year, but I don't see it happening.
Here's a really good way to look at this. There are prediction markets. This one, Kalshi, is the one I use, Kalshi. Chances of a rate cut by May of 2024, 29% chance. And these are people actually making bets on these things. And so it has gotten pushed out. And I guess 74% chance by the fourth quarter of next year, people think there'll be a rate cut. So we're a year away from a rate cut. Everybody needs to just take that off the table, which means the translation for founders, for GPs, is performance has to go up. You got to beat 5, 6, 7% or whatever people are going to get on those other instruments, corporate debt, 10, 11, 12%. You got a really hard bogey to beat here.
The alternative to that statement is that total capital has to go down in order for the capital remaining to have its return multiple increased, given that there's a generally set number of companies that are going to generally create a certain amount of value over the next couple of years.
And the way to create that value is?
So if that's true, well, I'm saying if there's a bunch of startups that are going to make $100 billion of market value over the next 5 to 7 years, you need to have less capital going into those companies in order for that capital to generate a higher return.
Which on your day-to-day basis means what, Freeberg? Explain on a day-to-day basis.
On a day-to-day basis, it means there's going to be less companies that are going to get funded, but more importantly, there's going to be less LP money going into venture. And there's going to be less capital available to fund startups in aggregate by a significant amount.
On a daily basis, you need to do more with less as a founder. You need to delight customers with less resources, spend less money on marketing, spend less money on teams, and get to profitability. You've got to be a stronger founder. I'm seeing it across the board in the seed stage. 2, 3, 4 founders raising $250 to $1 million instead of raising 3 to 5.
I got to be honest, Chikel, I thought it was much easier to kind of say the sky was falling this time last year than right now. And I think that people are a little bit, again, exhausted about hearing this message constantly of like, cut more. It's like, I think that they're exhausted. And I see a lot of founders that are exhausted. And
giving up. There's a lot of giving up.
They're like, I can't cut anymore. And now I do think we have to go back to them and say, if we're doing our jobs right, look, our strategic view was right, but the time scale of our analysis was wrong. And I think now you got a plan to mid-26. I don't even know where to start, to be honest, with that conversation.
What I'm seeing is people are merging companies and M&A is picking up because, hey, you got 2 companies doing $5 million each, but they're burning $2 million each a year. Cut half the team, put one team with the other. And I think you're going to just see some of that portfolio consolidation happen. Go ahead, Sachs.
I think